From the morning reading, mixed messages here as stocks hold tough, but typical pattern is for more selling pressure after rebounds from a low. Optimism drops from mild optimism as some indicators show optimism while others are just emerging from pessimism. Very mixed. The typical pattern is to see selling pressure kick in after 2 to 3 days of rallying from a low. So that is still in effect heading into the next week. There are multiple layers of potential resistance just above as investors caught in Monday's free fall see an opportunity to get out at break-even prices. That's the battle buyers always have to fight after a big decline. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:38 a.m. Central Time, and I'm recording this in preparation for the market day of August the 31st, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's see what happened in the overnight. And indeed, we had some weakness in the overnight. It was down almost 1% on the ES, or about 17 futures points. We're down a little over 0.5% in the Russell. Kind of interesting that that one's holding up better. NASDAQ down about 0.75%, and the Dow actually down just a fractional more than the S&P as a percent at the time of this cut. Crude oil down big, down about 1.8%. Euro up about 0.25%, as is bonds, and then gold down about 0.25%. In overseas action, not quiet there. China was down almost 1%. Hong Kong up about 0.25%. Japan down about 1.25%. Germany down about 0.5%. United Kingdom up about 1%. In terms of macroeconomic reports for today, you have a big week this week in macroeconomic reports. So that's something to kind of keep in mind. Obviously, this should be first Friday of the month, so the big monthly unemployment should come this week. So a lot of things happening this week, so you got to stay aware of what is on the slate for the macroeconomic reports. In terms of today, during market hours, you have Chicago PMI. And you see there's a lot of things going on in overseas reports as well. In terms of market condition, we had a quieter day on Friday with a non-standard deviation moving today. It pretty much just kind of stayed in the same place. But you see, obviously, we've had enormous amounts of volatility in the 2-week period, including significant numbers of 2 and even 3 standard deviation moves. So, that is currently the story and will continue to be the story, I suspect, into the ongoing future, at least the short term. IV percentiles actually right now are right about average, though. So 50 for the S&P, 48 Russell, 52 NASDAQ, 61 for the Dow. You do have the skew pretty high here. It's up over 125, so that's our first warning threshold. 130 is a significant warning, so that should be in your mind. Also, obviously, the short-term VIX at a 27.11 is also pretty significant. So clearly, we're a long way from that 11, 12, 13 range, and don't look to be ebbing off any significant amount for a while, even with the rally that we've had in recent days. Obviously, it's not a 50 like it was last Monday, but 27 is pretty high. In terms of our regular daily report, we still have trend breaking. A lot of weakness across much of this. IBD status, market in correction. The accumulation distribution scores have as E on both S&P and NASDAQ. GMI index, I read an interesting article from this author over the weekend. He is not just 0 out of 6 with a sell signal, but he's actively in his trading account over 90% in cash, and is actively moving his regular pension and 401k type of holdings into cash in the next few days to weeks as well. The way he put it is that he would rather risk missing a 5 or 10% up move and avoid a 20 to 40% down move. And so that should tell you a little bit about what that author thinks of the current opportunities and also the bias in terms of where the market is going. So both a subjective assessment as well as an objective assessment using his GMI index, which has also issued a sell signal. A primary market condition right now is a neutral bull. So this stayed for so many years a strong bull. We almost didn't even pay much attention to it. It was just assumed there would still be strong bull. Well, it's actually fallen a couple measures. It's gone through strong bull to weak bull down to now neutral bull, and the next level for that to fall to would be neutral bear. So this is definitely coming down, and still holding on to barely a bullish long-term stance, but that is as weak as that stance gets without just flipping to the bear side. In terms of the decision points, scoreboards, still all the red arrows here, very, very poor posture. And in terms of our intermediate term market posture, it actually has flipped to weekly bullish. And you see down here S&P actually up to a 25.8 and upturning, so weekly bullish, as did the Dow and the NASDAQ. NASDAQ and the Dow both a little stronger. It's actually good that the NASDAQ is leading. That usually is a stronger indication for the bulls. So there are some bright spots for the bulls. However, the Russell is still in correction territory at below a 20, and still quite bearish. So if you're looking for the growth components of the NASDAQ and the Russell to be leading, very mixed signals there. Our hedge warning status remains as a threshold level 3, which is our crash warning level. Now remember, this is an assessment of the level of risk in the market, not a prediction of that we're going to drop 20 or 30 or 40% or anything like that. But we certainly have very elevated levels of risk in the market. And you see from the volatility-based metrics, market in decline, sharp increase warning of both fired. Obviously, the VIX is above an 18. Our distribution day count is very, very high. Skew is above 125, as we mentioned a few moments ago. But on the plus side, the New York Stock Exchange new high, new low, very benign at 56.15. So not a warning there at least. And then you have also on the risk aversion indicators, we actually have 2 out of the 5 that are flagging as risk on. So some things popped and have come back into warning statuses, and some things have ebbed off. So not quite as bad as it was, but the most important ones that we look at, the IBD status, the GMI, and other factors like that, still have us as a threshold level 3. Now, if we actually are able to break through some of these important levels of resistance that we have had in recent days, and retain the prior range, then obviously we would not be in hedge warning status 3. But there's a lot of overhead resistance to get through for this recovery to come back into this prior range. And I wouldn't be betting a lot of dollars on that happening, at least the first time. This is a huge retracement, about a 50% retracement if you're using fib retracements, and really, frankly, a prime place to roll over. And certainly the overnight action, which is currently down about 15 points, so not as bad as it once was. It was down as much as 20 or so during the overnight, but still Pretty significant down move, and we'll see where the cash market takes it once that opens. But this is kind of prime territory for a bit of another leg down, especially if it's going to be a bearish continuation pattern, and that we would visit the and test the prior lows. Would not be an unusual circumstance by any measure. Obviously, macroeconomic reports could drive this one way or another. If we do make it back up into this area here would likely be a significant area of resistance again, and then if we should break through that, then that basically kind of invalidates all this action and puts you back into the range, and that would be frankly pretty confusing in terms of being able to understand where we might be going next. In terms of the more aggressive markets, the Russell obviously very bullish, but also in a very similar pattern, very bullish as of the last 3 days, but very, very bearish in the longer term patterns, and in a similar pattern as the S&P. NASDAQ, perhaps more of a recovery here, but still a long way to go. There's a lot of damage done last week, especially last Monday, and this is not going to get healed, by a couple of good up days. So probably enough on that. And in terms of sector specific, I didn't mention about the special opinions. Option income strategies, VIX is outside the acceptable window, so certainly at least for novice traders, not a very good market environment to be initiating option income strategies, and frankly even for aggressive traders, when you have this kind of volatility and this kind of range action, pretty difficult to maneuver that with option income strategies. You are bringing in more premium, but the amount of Vega and Delta action that you can have right now will certainly easily overwhelm whatever theta that you are making. So probably best to stand aside on most option income strategy approaches at this time. Covered call strategies, not initiating new positions this time. I'm not initiating anything new, and in fact I'm taking opportunities to peel off positions. I took one off on Friday that had managed to get back to a small profit, and to me that was an opportunity to lighten the load and not initiate new positions in this current environment. Put selling, the same kind of thing. This perhaps is the first thing that you start to do when you see a bottoming pattern, and if you think that the bottom is in, this would probably be the first go-to strategy. Consider scaling in, consider using a spread instead of just a naked put. So a couple defensive postures with that approach if you're going to start putting on some new put selling positions. In terms of the relative rotation graph here, you can see this is very, very ugly. Really only two, and weekly so, industry groups that are kind of in the all green, kind of in the right patterns and so forth. This FDN, the Internet Index Fund, and ITB, the Home and Construction Fund. The home builders and so forth certainly have had some bright news coming out of late. And you see this defensive sector here, XLU, that has been moving in the improving direction. But many of these big naked negative tails, KRE, XBI, and others that have been coming way off of late. A lot of damage done last week. In terms of sector-specific market postures, with the bullishness of recent days, you've seen some have come back to neutral. Note the one that is probably improved the most, consumer discretionary, but still, a pretty poor kind of picture there for initiation of any new positions. If you're looking to, and we have to start thinking in terms of bearish potentials, if you're looking to initiate new bearish trades, then obviously some of these, such as Um, the healthcare has been, significantly pressured of late, and this normally has been a very bright spot. So, whether you want to pick on some value plays in healthcare, if you think that this market is going to correct and make another leg higher, and healthcare is at a value play right now, that might be something to kind of consider. But I'm not much of a value play trader myself, but that's something that you kind of can look at this in the reverse. We tend to look at it as, who's the strongest. Well, when you're in a bear market, you might look at it as who's the weakest and who do you want to play in that direction. And certainly industrials would certainly be a great example of that. In terms of recent action, obviously energy's had a major move, and with that materials in the recent days. But they've also had the most to come back from. You see the 3-month here and the year to date. Those are the two sectors that have gotten hurt the most. And while a pretty significant bounce in recent days, they could easily give all that back. So very, very speculative trading in that sector right now. So that should be enough for today. As always, if you find what we're doing here is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers and StockTwit followers, and liking us on YouTube or subscribing to us on the YouTube channel. All those things very much appreciated. As is any kind of questions or commentary, back to our email address at support@falconglobaltraders.com. More information about what we do can be found at this website. And disclaimers, as always, hit the pause button if you need more time to review the disclaimers. And we'll see you back here tomorrow morning before the market opens with the market preview. Good trading.